Hello everyone, welcome to today's US Open live webinar, a live session that is hosted twice a week, every Tuesday and Thursday at 14:20 GMT, 10 times before the open of the US markets. This is host Nikos Zabouras, Senior Market Specialist at FXCM. During these sessions, we take a look at current events and news, as well as technical outlook of certain products, ranging from Forex to indices, commodities, and other asset classes, and in general, anything that has drawn my attention during the day and the week. Before, however, we begin, please take a look at the disclaimers and read warnings. Please read carefully, so then we can begin. Once again, please read carefully through the disclaimers and risk warnings, and we'll get the ball rolling shortly. Okay, let's go ahead. As we look at the Euro USD, before we get into the technicals, let's see what this week and this day had stored for us. So the week started with risk aversion, mostly emanating from the COVID-19 situation in China. Cases there are on the rise, and the authorities also reported the first related deaths, unfortunately, in recent weeks, and this has not happened in a long time. This, of course, led to risk of flows towards the US dollar, but the greenback faces difficulties again today as sentiment shows some improvement, but remains fragile. Now, oil prices saw volatile moves yesterday in two-way actions, because of a report from Wall Street Journal that OPEC considers an output increase next month, but Saudi Arabia quickly denied it. We'll get a little bit more into it as we move along with our session today. Now, in other news, we had the Organization for Economic Cooperation and Development, the OECD, out with its latest economic outlook. It does not see a recession, in its baseline scenario, but does project a significant slowdown in 2023 and in terms of global GDP, and called for further monetary tightening in order to fight inflation. Now, for the United States and the euro area in particular, GDP is projected to grow by just 0.5% in the next year. Now, we also continue to see a stream of speeches from officials from the European Central Bank and the Fed. In both instances, we have some different views as to the size of the next move. Some are in favor of keeping up with these big outsized hikes that we have seen from both sides, where others are ready for a slowdown in the pace. But in any case, everyone seems to expect more tightening ahead, as of course inflation remains high and more work needs to be done. On the corporate news front, Disney ousted its CEO and replaced him with his predecessor, and the stock actually jumped on the news yesterday. And Mr. Iger is seen as a highly successful CEO, the replacement that is, and that was seen as good by the markets. Now, oil giants European-based Shell, BP, and Total are having a good day after the OPEC denial that we discussed. OPEC seems committed to its output reduction program. And on the earnings front, Chinese firms are still in the spotlight. Smartphone making Xiaomi reports on Wednesday. Now, having talked of the general backdrop for today, let's go ahead and check the technical outlook, and let's start with Euro USD as usual. Now, the pair comes from the first losing week in around a month, and the current one also started on the back foot because of this risk aversion that we talked about earlier. Now, the pair is in risk of breaching the 1.09 for support, but a strong catalyst would be needed for parity to be questioned in the near term. We have talked about it again, that given its recent advance, the common currency seems better positioned to defend parity in case we move back towards those levels. However, despite the poor start to the week, it finds renewed support today, stays above the critical 38.2% Fibonacci at the area we mentioned earlier, and as such, it has the ability to push again for the 200 days EMA at around 1.039, but we can say that it does inspire much confidence at this stage for an even bigger recovery and new highs above 1.05. Now, that's it for the Euro USD. I want to also take a look at NZD USD. So here we have NZD USD, the QE, and that is because tomorrow we expect the latest monetary policy decision from the Reserve Bank of New Zealand, which is one of the most hawkish central banks out there, with having delivered 325 basis points worth of hikes. And the last 5 meetings have been of 0.5% increments. The bank expects further tightening, unlike its Australian counterpart, which has already slowed down the pace of hikes, and the Fed and the European central banks, which are apparently considering smaller moves ahead. The RBNZ has not shown any such inclination. And we also expect the updated forecasts tomorrow from the central bank. The last ones from August projected the official cash rate at 4.1% this year, which leaves room for a 75 basis move, an even bigger one this time around, since rates currently stand at 3.5%. Now, inflation, CPI inflation, is just slightly in the third quarter to 7.2%, but remains close to the 32-year highs. So definitely we'll be eagerly waiting to see what the central bank will decide tomorrow. Now, on the technical front, NZD USD struggles to extend its 5-week recovery ahead of the 200 days exponential moving average. It will be this area that you see here that I highlighting in red. As such, it is susceptible to pressure towards the 0.6 region, but it will need a strong catalyst for convincing moves below a critical confluence of support at the area we highlight here, which is in the mid 0.59s. We have Fibo levels there, Fibonacci levels, the ascending trend line from the 2+ year lows, and the 200 period EMA. Now, as things stand now, given the recent recovery, bulls are in the driver's seat, but we'll need fresh impetus to break above the region we mentioned earlier at 0.623. but the August highs at 0.6469 remain distant. Once again, caution is needed since the next leg of the move is likely going to depend from the decision from the Reserve Bank of New Zealand. Now let's move ahead. This is the outlook for the Kiwi. I want to move now to US oil because of the activity we discussed about earlier. So what we had here is yesterday we had the Wall Street Journal reporting that OPEC plus, the oil producing countries along with allies, what is usually referred to as OPEC plus, we had the newspaper reporting that the group is considering a production increase of 500k barrels per day, and this caused a sharp drop in prices. But the Saudi energy minister, quickly refuted this report, reiterated the commitment of the group to the current massive 2 million barrels per day cuts, and US oil quickly covered the losses and rises today. Now, so there is a push and pull here between demand forces and supply forces, because we have OPEC sending a strong signal with its output cuts and yesterday's comments by the Saudi minister that a message that it is ready to support prices. But on the other hand, we have demand fears due to the global tightening monetary environment, the COVID-19 situation in China, which is the world's second largest economy and second largest consumer of oil, and other factors. And let's not forget that OPEC itself has been lowering its demand growth for the next year over the last few months. So where does this bring us? Now, since US oil stays on the front foot today, it has the ability to push towards the 200 days period EMA at around this region, around 86.30, but it's early to talk of further recovery past 19 towards the November highs around here. However, given those demand fears that we discussed and prospects of a economic slowdown globally, there is risk of further pressure and new 2022 lows, which US oil avoided yesterday, but there is still risk for that, 74.26. But it's not easy at this stage to see sustained weakness below those levels, because OPEC supports prices. Now, we don't know what they're going to decide. Their next meeting is in early December, but as things stand now, that's our view on the commodity. And we're already 4 minutes into the US trading session, so let's go ahead and check Wall Street and the broader SPX 500. Now, the index has been consolidating this week. You can see here this consolidation above the daily Ichimoku cloud, which creates a little bit of a mixed outlook. Bulls have the ability to push for new highs at around 4,045, but don't really seem ready to challenge the 4,120, 4,146 region, which is a September highs and the descending trend line from January's record highs. Now, on the other hand, this lack of progress and, let's say, vigor makes the index susceptible to downside pressure, but I think a catalyst would be required to see daily closes below the critical 3,860, 3,833 region, which where the fib of the recent move higher and the 200 period EMA sit. So, of course, a convincing break below this level would put near-term bias on the downside, but as things stand now, bulls are in the driver's seat. So that is pretty much it from the technical outlook. Let's wrap things up with what to expect for the days ahead. Now, we need to remind you that it is a holiday shortened week in the United States due to the Thanksgiving day. Wall Street will be closed on Thursday and will be a half day on Friday. Of course, this also affects trading hours of various FXCM products. So you can check those on your respective FXCM websites, the respective sites of your region. And of course, caution is needed due to liquidity and volatility conditions. Now, on Wednesday, tomorrow, as we said, we expect the Reserve Bank of New Zealand. And we also expect the accounts from the last Fed meeting. This in the last meeting, there was another 75 basis points hike, but the central bank had pointed to a slower pace of hikes at some point. Chair Powell, however, had ruled out any pause and had talked of potentially higher terminal rate than previously expected. So markets will have the chance to maybe get some more insight into the policymakers' thinking. There are a few other things tomorrow, like some PMIs, which we will be also following. And on Thursday, we also have some more news, but nothing like super big. The truth is, of course, we will be looking into any commentary from central bank officials. And that's pretty much it for today. Of course, you can always go to our written content on your respective FXM websites, and anything else we will talk about on Thursday, again at 14:20 GMT. That's it from me today. Thank you for joining me.